The stock market grows by 10% a year on average, but most investors are losing money. Why? Volatility. Let me show you exactly what I mean. Here's how the stock market has actually performed over the last several years. In 2018, the market fell by 4%. Then in 2019, it shot up 31%. In 2020, despite all the pandemic chaos, it still finished up 18%. 2021 saw another massive jump at 28%. Then 2022 hit, and the market dropped 20%. But 2023 bounced back with 24% gains. 2024 added another 23%. And so far in 2025, we're up 16%. Now here's where most people get it wrong. They see the market crashing 20% in 2022, panic sets in, and they sell everything at a loss. Then they hear the news that markets are breaking records in 2023, everyone's getting rich, and that's when they jump back in and buy at the peak. You see the pattern? They're buying high and selling low, which is the exact opposite of what you need to do to make money. You don't need to be a financial genius to understand that this strategy is a guaranteed way to lose money. But here's the good news. If you have the right investing strategy with the right ETFs, you can ride out this volatility. Even better, you can actually profit from it. In this video, I'm going to walk you through 5 different categories of ETFs that you can consider holding for the next 2 decades. Not 2 months, not 2 years, but 2 decades. These are the types of investments that can help you not just survive the market's craziness, but actually thrive through it and build real wealth over time. Before we dive in, let me be crystal clear about something. I'm going to share specific examples and ticker symbols, but I'm not a financial advisor. I'm just a guy on YouTube sharing what I've learned about investing. Investing always carries risk. You're never guaranteed to make money when you invest. In fact, you will lose money at some point. That's just how markets work. So make sure you always do your own research and never blindly trust anyone on the internet, including me. With that out of the way, let's get into it. Before we jump into the 5 categories, we need to understand exactly what an ETF is and why it's such a powerful tool for building wealth. When you buy a stock, you're not just spending money at a company, you're actually buying a piece of that company. Think about McDonald's for a second. Instead of walking into McDonald's and buying a burger and fries, what you're doing when you invest is buying a piece of the actual corporation. So when other people go buy their burgers and fries, you make money as a shareholder. But here's the problem with investing in just one company like McDonald's. If McDonald's starts having problems, maybe they serve contaminated food, they get hit with lawsuits, or worst case, they go bankrupt, you could lose all your money. On the flip side, if McDonald's does really well, open stores on every corner around the world, and their profits explode, their stock price goes up, and you get rich. The challenge is that most people don't know how to analyze a stock properly. They don't know how to read financial statements. They don't know how to research the company's competitive advantages. They don't know how to keep up with quarterly earnings reports. And even if they did, they don't know how to manage their emotions when the stock drops 30% in a month. This is where ETFs come in. There are 2 main ways to invest your money. You can invest directly into an individual company like McDonald's, or you can invest in a fund. ETFs, which stands for Exchange Traded Funds, are one type of fund, and they're basically a basket of stocks all wrapped into one investment. Instead of putting all your money into just McDonald's, an ETF lets you invest in a fund that holds McDonald's, but also Apple, Amazon, Nike, Coca-Cola, and potentially dozens or even hundreds of other companies, all at the same time. Now your investment success doesn't depend on just one company doing well. Here's the beautiful part. You find the right ETF, you invest your money into it, and then you let the fund do all the heavy lifting. If something bad happens to McDonald's and they start producing terrible food, or their business model falls apart, the fund managers will kick McDonald's out of the ETF and replace it with something else, maybe Chipotle or another growing restaurant chain. You don't have to do anything. It's completely passive. The fund is constantly monitoring and rebalancing itself. Your job is simple. Keep buying the fund and holding it for decades. That's how you build wealth with ETFs. You're not trying to pick the next Amazon or avoid the next Enron. You're investing in the entire market or specific sectors of the market and letting time and compound growth do the work for you. This is what makes ETF investing so powerful for regular people who don't have hours every day to research individual stocks. Now let's talk about the strategy you need to win with these investments. Before I show you the 5 categories of ETFs, you need to understand the strategy that makes all of this work. I call it ABB. Always be buying. The way you win as an ETF investor is simple. You set up a system where money automatically gets pulled from your checking account and invested into your portfolio of ETFs on a regular schedule. Every week, every 2 weeks, or every month, depending on what works for your budget. The investment happens automatically, whether markets are going up, whether markets are going down, or whether markets are moving sideways. The key word here is always. Always be buying. Because here's what happens to most people. When the market crashes and their portfolio drops 20% or 30%, they panic. They start asking themselves, should I sell? Should I get out before it gets worse? But that's actually the exact time you should be buying more, not selling. Think about it like this. When the stock market falls by 20% or 40%, everything is on sale. You can buy more shares of the same investments with the same amount of money. It's like walking into a store and seeing everything marked down 30% off. Would you stop shopping? No, you'd probably buy more. And here's what we know for certain. Over the long run, markets go up. They don't go up every single year. We've seen that with the performance data from 2018 to now. But over decades, the trend is always up. So if you can buy more shares when markets are down, you're setting yourself up to build wealth faster because you're getting more for your money. Most people do the opposite. When markets crash, they freak out, they panic, they sell at the bottom and lock in their losses. Then, when markets recover and hit new all-time highs, that's when they feel confident enough to jump back in and buy. They're literally buying high and selling low, which is the worst possible strategy. If you can train yourself to buy good investments when everyone else is panicking and selling, you can grow your wealth significantly faster. This is what separates successful long-term investors from everyone else. It's not intelligence. It's not having access to special information. It's having the discipline to keep buying consistently, especially when it feels uncomfortable. This strategy is also called dollar cost averaging. When you invest the same amount of money at regular intervals, you automatically buy more shares when prices are low and fewer shares when prices are high. Over time, this averages out your cost per share and protects you from trying to time the market perfectly, which nobody can do consistently. Set up automatic transfers. Remove the emotion from the decision. Make it so that you're investing before you even have a chance to spend that money on something else. This is how you build wealth with ETFs. Consistency beats perfection every single time. Now let's get into the 5 categories of ETFs you can consider for the next 2 decades, starting with number 1. The first category is broad economy ETFs. This is the most broad approach and generally the lowest risk option when it comes to ETF investing. Look, I don't know what AI is going to look like in 5 years. I don't know what healthcare is going to look like in 10 years. I don't know what's going to happen with real estate in 15 years. But what I can predict with much more confidence is that the overall economy is going to grow. Economies expand over time. That's how the system works. So one option is to just invest in the broad economy. And it doesn't have to be just the United States economy. You can invest in the entire global economy. Let me give you some specific examples. VT is an ETF created by Vanguard that gives you exposure to the total world stock market. When you invest in this one single ETF, you're getting exposure to approximately 10,000 stocks from around the world. You're investing in companies from the United States, Europe, Asia, emerging markets everywhere. As the global economy grows, your investment grows with it. Now, because it's so incredibly broad, you're not going to see massive explosive gains. You're going to be held back a bit by slower growing countries and regions that might be going through recessions or economic struggles. But you also get maximum diversification across the entire planet. If you want to narrow it down one level and focus just on the United States, you can look at VTI. This is another Vanguard ETF that gives you exposure to the total United States stock market. There are about 3,500 stocks in this ETF. You're getting exposure to small companies, medium-sized companies, and large companies all across the American economy. If the United States economy grows, this fund generally grows with it. Now, if you want to get slightly more focused but still stay broad, you can look at SPY. This ETF tracks the S&P 500, which is a collection of the 500 largest companies in the United States stock market. You're still investing in the broad economy, but you're concentrating on the biggest, most established companies. You're not including the thousands of smaller companies. The beauty of the S&P 500 is that it's self-cleaning. If one of those 500 companies starts struggling, let's say McDonald's starts failing, the S&P 500 will kick McDonald's out and replace it with another growing company. So you're always invested in the top 500 companies, not the same 500 companies forever. Then you have QQQ, and I was actually debating whether to include this one in the broad economy category or save it for later. QQQ gives you exposure to the NASDAQ 100, which is the 100 largest non-financial companies in the stock market. These are primarily technology companies because right now, the biggest non-financial companies in America are tech stocks. This one is more volatile. When markets go up, QQQ tends to go up even more. When markets go down, it tends to go down harder. But it's still a broad index of the largest tech-focused companies in the economy. So to recap this category, if you want maximum global diversification, VT covers the world. If you want to focus on America's entire market, VTI gives you 3,500 stocks. If you want just the largest 500 US companies, SPY tracks the S&P 500. And if you want the biggest non-financial companies with a tech focus, QQQ covers the NASDAQ 100. These broad economy ETFs are the foundation that many investors build their portfolios on. They're simple, they're diversified, and they let you invest in economic growth without trying to pick individual winners. Now let's move to the second category, 5. The second category of ETFs that investors should consider holding for the next couple of decades are dividend ETFs. I personally love investing for cash flow, and this is where dividend investing really shines. Before I go deeper into this, I want to remind you that if you're serious about becoming an investor, I've put together a brand new free investing masterclass. I'll walk you through how to get started as an investor and show you exactly how to research investment opportunities. I'll show you the same framework that my firm at Market Briefs Pro uses to find opportunities before they hit the headlines. It's completely free. When you register, you'll also get access to Market Briefs, which is my newsletter for investors. The link is in the description below. Now let's talk about dividends. There are many companies in the stock market that don't make any profit. At the end of the year, they have no cash in the bank. They're actually relying on investors to keep funding them so they can continue operating. Then you have companies that are profitable. At the end of the year, after paying all their expenses, salaries, rent, everything, they have a pile of cash left over. That's their profit. These profitable companies have 3 options for what they can do with that cash. Option 1, they can save the money for emergencies or future opportunities. Option 2, they can reinvest the money back into the business to open more stores, fund more research and development, or increase their marketing and advertising. Option 3, they can give some of that money directly to their shareholders, people like you who own the stock. Many companies choose to do all 3. They save some, or reinvest some, and give some away to shareholders. One way they give money to shareholders is by depositing cash directly into your brokerage account. That's called a dividend. It's a cash payment you receive, usually every 3 months, just for owning the stock. You don't have to do anything except own the right investment. Now, you could invest in individual dividend-paying companies, but then you'd have to constantly monitor each company, study their financial statements, and make sure they're still good investments. Or you can invest in a dividend-focused ETF that does all that work for you. These ETFs invest in a basket of dividend-paying companies, giving you more stability and less risk. Let me give you some examples. SCHD is an ETF created by Schwab. Full disclosure, I personally own SCHD in my portfolio. This ETF focuses on high dividend-paying companies in the United States that have strong track records of consistently paying and growing their dividends. You're getting exposure to quality companies that not only pay dividends, but have a history of increasing those payments over time. The goal is dividend growth plus stock price appreciation. VYMI is another ETF I personally own. This one invests in high dividend-paying companies outside of the United States, so you're getting international exposure. The interesting thing about international companies is that many of them pay higher dividends than their American counterparts. You can see higher dividend payments, but there's more risk because you're investing in smaller economies and different regulatory environments. However, because they're sometimes smaller or less mature markets, you also have potential for more growth. NOBL is for the more conservative dividend investor. This ETF focuses on dividend aristocrats within the S&P 500. What's a dividend aristocrat? It's a company that has not only paid a dividend, but has increased that dividend every single year for at least the last 25 years. That's an incredibly exclusive club. These are established, stable companies with proven track records. You'll see slower growth and lower dividend yields compared to others, but you get more predictability and stability. Then you have VIG, which is another dividend growth ETF created by Vanguard. This one focuses on companies that have paid and increased their dividend every year for at least the last 10 years. It's less strict than NOBL's 25-year requirement, so you get exposure to more companies, including some that are growing faster but still have a solid dividend history. Now let me be honest about dividend investing. There are 3 reasons why people hate this strategy. Reason 1, when you invest for dividends, your growth is typically slower. Companies that pay out cash to shareholders aren't reinvesting all that money back into the business, so the stock price usually doesn't grow as fast as high-growth tech stocks. Reason 2, taxes. When a company makes a profit and pays it out as a dividend, the profit gets taxed at the corporate level first. Then when you receive the dividend, you have to pay taxes on it again as income. So there's a double taxation issue you need to consider. Reason 3, it takes a long time to see meaningful results. I like to say that dividend investing requires a decade of sacrifice. Year 1, you invest for dividends and see almost nothing. Year 2, still almost nothing. Year 3, barely anything. Year 4, you start to see a little bit of cash flow. Year 5, it's not too bad. Year 6, you're seeing a bit more. Year 7, now you're starting to see real gains from the dividends. Year 8, you're seeing the potential. Year 9, it's looking much brighter. And by year 10, you have a whole new stream of income coming in without you having to work for it. Most people don't want to wait 10 years to really see the dividend income build up. They want results now. But if you have the patience and you value that steady cash flow, dividend investing can be incredibly powerful. Here's another advantage. When markets crash, companies sometimes cut their dividends, which often hurts the stock price even more. But if it's a good company with a strong business model, that's your opportunity. You can buy the stock at a discounted price while they're still paying dividends, even if those dividends are temporarily reduced. Then, as the company recovers and grows again, they start increasing their dividends. So you're seeing growth in the stock price. Plus, you're earning more cash flow because you bought more shares at the low price, and each share is now paying out bigger dividends. Dividend investing is for long-term patient investors who want to build a passive income stream. If you're impatient and want quick gains, this will feel like torture. But if you're willing to sacrifice now for income later, this can transform your financial future. Now let's move to category 3. The third category is international ETFs. And I've been talking about the importance of international diversification for years now. Over the last couple of years, investing in international companies has become extremely popular because these investments have been growing fast. Why the sudden interest? There are a few reasons. Post-pandemic, people started worrying about inflation in the United States. They're concerned about the strength of the dollar. They're worried about tariff policies and trade wars. They're concerned about political instability and market volatility concentrated in U.S. markets. Whatever the specific reason, investors are now looking for diversification outside of the United States, and that demand has actually benefited international stocks from an investment standpoint. But the bigger picture is this. There are parts of the world that are less developed and have more room to grow. There are emerging economies that are rapidly expanding their middle class. There are countries that are diversifying away from dependence on the U.S. economy. All of these trends create opportunities, and there are many ways to invest internationally, even if you're based in the United States. Let me walk you through some options, starting broad and getting more specific. VXUS is an ETF created by Vanguard that gives you exposure to the entire global stock market outside of the United States. This fund holds about 8,000 companies from developed countries like Japan, the United Kingdom, and Germany, as well as emerging markets like China, India, and Brazil. Everything except U.S. companies. If you want international diversification but don't want to pick specific regions or countries, VXUS gives you the whole world minus America. If you want to focus more on established, stable economies and skip the emerging markets, you can look at VEA. This ETF gives you exposure to developed countries around the world but excludes the emerging markets. You're investing in places like Japan, the UK, France, Germany, and other mature economies with established financial systems and stable governments. Less risk than emerging markets, but also potentially less explosive growth. Now, if you want to take on more risk for potentially higher returns, you can look at VWO. This ETF focuses specifically on emerging markets like China, India, Taiwan, Brazil, and other developing economies. These countries have younger populations, growing middle classes, and economies that are expanding faster than developed nations. But they also come with more political risk, currency risk, and economic instability. Higher potential reward, higher potential risk. Maybe you don't want to invest in broad regions. Maybe you have a specific thesis about a particular country's growth potential. There are ETFs that let you invest in individual countries as well. INDA gives you exposure to the broad Indian economy. If you believe India is going to continue growing, that their population advantage and technology sector will drive economic expansion, this ETF lets you invest in that thesis. MCHI focuses on the Chinese economy. If you think China is going to continue being a dominant economic force despite tensions with the West, or if you believe their domestic market and manufacturing power will keep driving growth, this gives you that exposure. EWJ targets the Japanese economy. Japan has been making significant changes recently. They're raising interest rates after decades of near zero rates. They're shifting from a stakeholder-first economy to a shareholder-first economy, which means companies are starting to focus more on profits and returning cash to investors. If you believe these reforms will unlock value in Japanese companies, this ETF gives you access. EWG gives you exposure to the German economy. Germany is the largest economy in Europe and a manufacturing powerhouse. If you believe in the strength of European industry and German engineering, this is one way to invest in that. The point is, when it comes to international investing, you have options. You can go extremely broad with something like VXUS and own thousands of international companies. You can focus on developed markets with VEA for more stability. You can chase higher growth with emerging markets through VWO, or you can make specific bets on individual countries if you have strong convictions about where growth is going to come from. International diversification matters because no single country dominates forever. Economic power shifts over time. The United States has been the global leader for decades, but that doesn't mean it will always outperform every other market. Having exposure to international growth gives you more opportunities and protects you if the U.S. market underperforms for an extended period. Now, because we're talking about holding these investments for 2 decades, I wouldn't feel right making this video without talking about the fourth category, protection. Let's get into that now. The fourth category is protection assets, and some people just can't handle the stress of market downturns, and look, I get it. Over the next 2 decades, we're probably going to see multiple recessions. We're probably going to see several market crashes. Some people just can't stomach watching their portfolio drop 30%, 40%, or even 50% during those periods, huh? This is where having some protection investments can help you sleep at night. By protection investments, I mean assets that generally go up when markets go down, or at least go down less when everyone is panicking about the economy, inflation, or currency problems. Traditionally, that protection asset has been gold, physical gold. Now, I know this video is about ETFs, so I'm not going to spend a lot of time talking about buying physical gold bars or coins, even though that's actually my preferred way to own gold. But the alternative is to own a gold ETF. GLD is an ETF that gives you exposure to paper gold. Basically, you're investing in gold without having to store it yourself, deal with security, or worry about authenticity. But here's what you need to understand about gold. Gold does not always go straight up in value. Gold is not like investing in a business that produces products, generates revenue, and grows profits over time. Gold just sits there. It doesn't produce anything. It's not used heavily in manufacturing like silver or copper. Gold exists primarily as a hedge, as protection, as insurance. Gold generally goes up when people are worried about the economy, when they're concerned about the dollar losing value, when they're scared about inflation, when there's geopolitical uncertainty. That's when people rush to gold because it has limited supply and has been seen as a store of value for thousands of years. Let me show you what I mean by looking at gold's price history. During the 2008 financial crisis and the years that followed, gold prices absolutely exploded. Why? Because we had massive amounts of money printing happening between 2008 and 2012, quantitative easing, bank bailouts, stimulus programs. Everyone was worried that all this money creation would cause massive inflation, so they bought gold as protection. But then in 2012, when it became clear that we weren't going to have runaway inflation, gold prices crashed, and they stayed low. From 2013 to 2014 to 2015, all the way through 2019, gold was basically flat or down. It took 8 years before gold prices started hitting new record highs again. What changed? The pandemic hit in 2020. Massive money printing happened again. Governments around the world printed trillions of dollars in stimulus. Concerns about inflation started rising again, and gold took off. As of today, gold prices have been booming because of ongoing concerns about the dollar, inflation, and economic instability. So here's my point. I don't look at gold as an investment. I look at it as a hedge, as protection, as insurance for a small portion of your portfolio. A lot of people right now are looking at gold as an investment because post-pandemic prices have grown so fast. But historically, gold is not a great growth investment. It's a defensive play. Gold doesn't generate cash flow. It doesn't pay dividends. It doesn't produce earnings. It just sits there and hopefully maintains or increases its value when everything else is falling apart. That's its job. It's insurance against the worst case scenarios. So if you decide to hold some gold in your portfolio through an ETF like GLD, understand what you're buying. You're not buying it to get rich. You're buying it so that when markets crash, when there's a recession, when there's a currency crisis, you have something in your portfolio that might actually go up, or at least not fall as much as your stocks. Keep it as a small percentage of your portfolio, maybe 5%, maybe 10%, depending on how conservative you are. But don't go overboard thinking gold is going to make you wealthy. It's there to protect the wealth you're building with your other investments. Now let's talk about the fifth and final category, which is the complete opposite of protection. This is where things get riskier, but also where you have more potential upside. Let's get into risk-on investments. 8. The fifth and final category is risk-on investments. This is the riskier side of ETF investing, where you're betting on where you believe money is flowing and which industries are going to grow significantly over the next decade or more. This is what I call active investing. If you believe there is a specific industry that's going to explode over the next 10 or 15 years, this creates an opportunity for higher returns. But it's definitely more risky because if you're investing in one particular sector and a new president comes in and changes policy, or technology shifts in a different direction, or regulations crack down on that industry, it can seriously hurt your investment. But if it's something you truly believe in and you're right about where innovation is headed, the upside potential is much greater than broad market investing. You're concentrating your bet on a specific theme rather than spreading it across the entire economy. Right now, there are so many different trends happening. Genomics, molecular biology, robotics, cybersecurity, artificial intelligence, clean energy, space exploration. I could go on and on. There are ETFs for almost every major trend you can think of. I'm not going to give you an exhaustive list because that would take hours, but let me give you a few examples just to get your mind thinking like an investor. I mentioned QQQ earlier in the broad economy category, but I'm bringing it back here because it also works as a risk on play. QQQ gives you exposure to the NASDAQ 100, which is primarily tech companies. This is where you get concentrated exposure to the most innovative, fastest growing technology companies in America. It's more volatile than the S&P 500. When markets go up, QQQ tends to outperform. When markets go down, it tends to fall harder. But if you believe technology is going to continue driving the economy forward, this gives you leveraged exposure to that trend. Then you have SOXX, which focuses specifically on semiconductors. If you believe that the United States government pushing heavily into AI development, investing billions into semiconductor manufacturing, and bringing chip production back to America is going to create massive opportunities, this ETF gives you exposure to that. Right now, there's a huge push to manufacture more semiconductors domestically instead of relying on Taiwan and other countries. If that trend continues, semiconductor companies could see explosive growth. Is there risk? Absolutely. A new administration could come in and completely change the policy. We could see a shift in semiconductor demand. Global competition could intensify. But if you believe semiconductors are going to be even more critical in the future with AI, autonomous vehicles, and advanced computing, this is a way to invest in that thesis. Another example is QTUM, which focuses on quantum computing. This is truly next-generation technology. Right now, we have computer chips that are incredibly powerful. Quantum chips are like supercomputer chips on steroids to the 10,000th power. They can solve problems that would take traditional computers thousands of years to figure out. The catch? This technology doesn't fully exist yet in a practical, scalable way. Maybe it never will, or maybe it takes another 20 years to become commercially viable. But if quantum computing does happen, and most experts believe it will eventually, it's going to completely revolutionize our entire economic system. Everything from drug discovery to financial modeling to cryptography will be transformed. QTUM gives you exposure to companies working on quantum technology. It's a long-term speculative play. Nobody knows exactly when this technology will break through or which companies will dominate. But for investors who want to get positioned early in what could be the next major technological revolution, this is one way to do it. The idea behind these risk-on investments is to allocate a portion of your portfolio to areas where you believe money is moving, where innovation is happening, where growth is going to be concentrated. If you're right, it can significantly boost your overall returns. If you're wrong, you could underperform or lose money on that portion of your portfolio. The key is that you're not putting all your money into these speculative plays. You're not betting your entire financial future on quantum computing or semiconductors. You're taking a calculated risk with a portion of your portfolio, while the majority of your money is in safer, broader investments. These thematic ETFs let you invest in an entire industry rather than trying to pick which individual company is going to win. You don't have to figure out whether Intel or AMD or NVIDIA is going to dominate semiconductors. You just invest in the semiconductor ETF and get exposure to all of them. If the industry grows, you benefit regardless of which specific companies end up on top. So to recap all 5 categories: broad economy ETFs for foundational exposure, dividend ETFs for building passive income, international ETFs for global diversification, gold for protection during downturns, and thematic ETFs for concentrated bets on specific industries you believe will grow. Now let me bring this all together and show you how to actually build a strategy around these categories.